Equity Market Update, September 2020. After falling nearly over 5% during the month, Nifty 50 ended the month minus 1.2% lower than last month. The movement in equities was influenced by rise in risk aversion driven by rising number of infection in US and Europe, uncertainty around US elections and fiscal stimulus, prospects of fiscal stimulus from the government, improvement in economic activities, SEBI circular on multi-cap funds, etc. The large caps underperformed mid-caps and small caps during the month. Amongst the sectoral performance, IT and healthcare were the best performing sectors, while banking, oil and gas, and metals underperformed during the month. Globally, most major indices also delivered negative returns during the month. FPIs turned net sellers in September 2020 after being net buyers for the fourth month in a row and sold equity worth $1.1 billion. Net FPI inflows into equity in H1 FY21 stood at $10.2 billion as against net inflows of $1.4 billion in H1 FY20. Domestic equity-oriented mutual funds witnessed net outflows of INR 3,079 crore in September 2020 compared to net outflow of INR 6,056 crore a month ago. In the first 6 months of FY21, net outflows from domestic equity-oriented mutual fund schemes stood at approximately INR 10,267 crore as against net inflow of INR 33,432 crore during the same period last year. Outlook. As on 30th September 2020, Nifty 50 was trading at price-to-earnings multiple of 24.8x based on FY21 estimated earnings and 18.5x based on FY22 estimated earnings. While multiples are reasonable, especially considering the low interest rate environment, in uncertain times like the current one, limited reliance should be placed on the price-to-earnings multiples for gauging valuations as earnings are temporarily impacted, especially for FY21. In our opinion, the Indian market cap to GDP is a better indicator of valuation of overall market in the current scenario. As of 30th September 2020, the Indian market capitalization stood at approximately 73% of GDP based on 2021 GDP, lower than its 10-year average. Also, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield continues to remain below its 10-year average. This further indicates that equity markets are attractively priced. Additionally, 10-year Nifty 50 returns of 6.5% CAGR have lagged nominal GDP growth of 12% CAGR for the last 10 years. Historically, periods when Nifty 50 returns have been below 10% CAGR for a 10-year period, it has delivered good returns in the medium to long term. While the equity market has recovered significantly from lows seen in March 2020, the recovery is polarized, with top 5 stocks contributing a significant portion of the gain, and the broader market is still quite attractively valued and thus holds promise over the medium to long term, in our opinion. This view is also supported by signs of economic recovery becoming broad-based, favorable current account position, relatively better placed rural economy, and likely impact of fiscal and monetary measures. In view of the above, in our opinion, there is merit in increasing allocation to equities in a phased manner or in staying invested, as the case may be, for those with a medium to long-term view and in line with individual risk appetite. Significant rise in spread of COVID-19, unwinding of expansionary fiscal and monetary stimulus, sharp rise in crude oil prices, higher than expected NPAs post the moratorium, escalation of border tension between India and China, and/or trade tension between US and China, etc., are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.